The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody, and welcome to Stonehearth Capital Management's investment process update. I want to thank you all for joining us today on this wintry spring day we have here in New England. Gotta love the New England weather. Before we get started with the presentation, I'd like to go over a few housekeeping notes. One, we are recording this session. Not your voices, just my voice, and will be available for replay on our website 24 hours after the conclusion of this webinar. Also, during the presentation, or even now if you have them, we left a lot of time for question and answer at the end of the presentation. So if you look on the bottom right-hand side, you see a little chat box. This is where you can type in questions. I'm the only one who can see them. I'll receive them on my screen, and as time permits, we'll get to as many questions as possible at the end of the presentation. So please feel free, as we're going through it, to write out your questions. And lastly, please stay tuned for the last slide of this presentation, which has our compliance disclosures on it. So with that, let's get started. So recently we sent notification out, excuse me, that we're changing our investment process. And as I stated in my letter, we feel these changes really are evolutionary and not revolutionary. What does that mean? When looking at the investment process, we are constantly looking for ways to improve it. This is something I come into the office every day and attempt to do. So this is not something we take lightly, and we don't take changes very lightly. We come in every day looking for ways to improve the process. And we do feel the recent changes we have made to the process represent major improvements to this. And what are we trying to accomplish with our portfolios, or in closing, what are we trying to accomplish with our investment process? And this first slide right here really encapsulates everything we're trying to accomplish with your portfolio. And for those of you who've been with us for a while, you probably have seen this before. This is a slide I presented at my first breakfast seminar way back in 2012. It was true then, it's true now, and will be true in the future. It's one of my favorite two slides that we have in this presentation to really explain what we're trying to accomplish. So what are we looking at here? We're looking at two different cycles that we see take place in financial markets. And what I like about this is this can apply to any asset class and even your portfolio. So this is true for the U.S. equity market, which is true for the foreign equity market, fixed income, and your portfolio. We've seen this throughout time. And the first thing we're going to look at is this investment market cycle. And that's the center right here of this picture. And we've all experienced this. You can start right here with the market peak. So either stocks, bonds, foreign stocks, your portfolio peaks out, performance starts trending down, the crowd turns bearish, we get to the bottom, buy low, sell high. This is where we want to be adding risk to your portfolio. It's the best time to be purchasing assets. Again, look at the history, J.P. Morgan, who many of you have known from the J.P. Morgan Bank, but he was a financier way back in the early 20th century, and he had the famous quote, "The best time to buy is when there's blood in the streets." That's this low point. And then we see the market start going up, turns more positive, market peak, wash, rinse, and repeat. We've seen this throughout time, that this are how financial markets behave. What we also know throughout time is that investors don't actually behave this way. They let their behaviors, their emotions take over, and what we call the investor sentiment cycle. And that's this outside circle right here, represented by this lovely face. So if you look at the top right here, he's happy he got my stocks, but it could be bonds, could be anything in the portfolio. He's very happy, buying at the top. We see the market start turning bearish a little bit, emotions creep in, denial, fear. We've all felt these, myself included. You rationalize it, why to hold an asset, and you come right down to the bottom, the maximum point of pain, and this is where we have poor investment decisions, myself included. If we allow investor sentiment to creep into the process, we end up making poor investment decisions, which leads to a weakened investment process, which leads to poor outcomes. And then we watch it, markets slowly go up again, still let emotions take over until we get to the top, and again, wash, rinse, and repeat. We've seen this throughout time, and this is basically the fear and greed we see within investors. And what we're really trying to accomplish with our investment process is to keep us in this center circle. We really want to be in tune, or what we say in harmony, with what the market is telling us. When we should be adding risk, when we should be removing risk to take advantage of this market cycle. But what we've seen recently in our portfolios going on is that our current investment process structure was drifting closer and closer outwards, so towards the investor sentiment cycle and away from this market cycle. So we feel the changes we are making, which are only two and we'll go through, will really help us bring us back in towards this market cycle and away from this investor sentiment cycle. So by staying within this investment market cycle, we can take advantage of the investors who play out here in this outside circle and leads to better outcomes in our portfolios. So how do we do this? How do we kind of stay within this market cycle and away from the investor sentiment cycle? Well, our investment process is really built upon three pillars that are not changing. We don't see them changing. They're basically how our philosophy is built. And what we see here is these three pillars that really support our investment process. And the first one is active risk management. So this would be our old hedging process, which is now called dynamic asset allocation, which we'll walk through the changes in that. The second one, minimizing drawdowns. True before, it's true now. To keep out of that investor sentiment cycle, it helps to control those drawdowns, not lose as much money, keeps us away from making poor decisions, and keeps us in that center of the circle in that market cycle. And we do this by holding a portfolio of diversified assets and strategies. Again, not keeping all your eggs in one basket. As we've seen throughout time, that concentration risk people have in their portfolios, putting all their money into the U.S. equity market, leads you to that poor investment cycle place in the portfolio and leads to poor returns. So this is what we're trying to do. This is what it's built upon, and nothing is changed. So the changes we have made are really to the process and how we're trying to accomplish this, not to the foundation that it was built on. So what we're going to do is look at each individual pillar individually and really go through what's changing and, more importantly, what's not changing, from the least amount of change to the most amount of change. So the first thing we're going to look at is minimize drawdowns. What is changing? The easiest way, quickest way to explain this is nothing. We still believe in minimizing drawdowns. We still believe the key to making money is not to lose it in the first place. It was true then, and it's still true now. And it's simple. It's a mathematical certainty. If you have or suffer a 20% loss in your portfolio, you need 25% just to get back to even. If we're able to hold that loss to a 10% drawdown, you only need 11%. Again, by minimizing that drawdowns allows you to keep more of your assets in the market and prevents us from playing in the outside of that circle. We do not want to be in the investor sentiment cycle. We want to play in the market cycle. So by minimizing drawdowns, we can remove emotion and stay within harmony with what the market is telling us. So there's really no change to our philosophy of minimizing drawdowns. The second pillar we have is diversification of assets and strategies. And this is where the first change takes place. So what is changing? We are removing our internal trend following model. And again, we view this just as we would any other trade in your portfolio. If we felt U.S. equities weren't working, we may move into foreign equities. If we thought our quality factor was not working, we may buy a value factor. Same thing. After long analysis of this model, we found that it really wasn't delivering the outcomes we thought would help our investment process. So what we've seen is an increase in volatility and risk in this trend following model. And corresponding to this increased volatility, we saw a decreased expected return. So what does that mean? We've seen the volatility go up, poor returns, and we weren't compensated by getting any excess return. So as such, we felt that it was best to remove this strategy. It also we're seeing increasing correlation with other assets in the portfolio. One thing trend following was designed to do was to be a diversifier. So when the market zigs, this would be zagging, and we're really not seeing that. And some of these changes really have to do with the market structure. We have seen major market structure changes over the past few years. You've seen the rise of ETFs, you've seen the rise of computer trading, And basically what's happened, in essence, in short, without going into a lot of detail, is due to the rise of all these new financial instruments, investor timeframes have shortened. So we're seeing people trade in milliseconds now rather than days. And our trend following model really couldn't take advantage of this. We still believe in the trend following strategy. We still believe in managed futures. So managed futures, as you know, we hold AQR managed futures in most of your portfolios. This is a version of a trend following model run by an outside firm. They have a long track record of being able to take advantage of these market inefficiencies. So we're keeping that. So we just thought a decreased exposure to this strategy was warranted. Again, why did we make this change? We wanted to move away from that investor sentiment and more towards the market cycle. So we want to get in harmony with the market. So what isn't changing in our diversification of strategies and assets? Well, the first thing, the most important thing, is we still believe in holding a diverse basket of assets and strategies, that over time, through a full market cycle, this better helps us stay within that market cycle circle and away from the investor sentiment. By holding a diverse basket of assets, we are able to decrease portfolio volatility, that is the ups and downs that we see that lead to emotional decisions. And with this decreased portfolio volatility, we also see an increase in expected return over a long investment horizon. So by limiting the volatility, you get a higher expected return in the future. This helps decrease the correlation among assets in the portfolio. Again, if everything's moving as one, it feels good on that upside. When we saw our investment sentiment cycle at the top, when everything is going up, you feel great, but it doesn't improve your process and doesn't improve your outcomes. As that market sells off, you let emotions come in and end up making poor investment decisions. So what we're really trying to do with this is we still believe diversification helps us stay within that market cycle. We're just doing it in a much more efficient manner. So that's the number one change we're making. The second change we're making is to our active risk management strategy. So ARM, active risk management, pretty straightforward. What is changing? Well, the big one is we're removing hedging. We do an analysis on this approach. We still believe managing risk along the investment market cycle is a way to achieve better portfolio results. We just believe the hedging process was leading to an all or nothing approach. There was no shades of gray. It was either in the market or out of the market. And again, if we remember back to our investment sentiment cycle, it allows emotion to creep into the process. And there was too much emotion coming in with the hedging process, and we wanted to eliminate that. Again, thinking about how the market has changed, speeded up in trading, investment horizons shortening out there, and it just really wasn't delivering the portfolio results we wanted to see. And again, all due to eliminating behavioral biases. So the other thing we did was we eliminated the Sherman sheet when judging the risk in the market. Again, trying to remove emotion as much as possible. So now we're removing hedging. What are we adding? Well, we're adding what we're calling strategic dynamic asset allocation. And again, big fancy word for active risk management. We're still adjusting risk along the portfolio, in the portfolio through the full market cycle. We're just doing it in a little bit smaller increments. So it allows for shades of gray. It's not an all or nothing. It's not, as we see markets weakening, risk increasing, we're able to adjust the portfolio more gradually and not. So right now in the hedging process, we ended up selling a lot of equity at any one point in time. So what we want to do is take advantage of the time we have and deal with these shades of gray. It accounts for how the world currently is, not how it was, and not how we wish it to be. So it's more gradual. So the way to look at it is, if we see risk increasing in the markets, what we can do is maybe trade 10% of your equity and lower that down, go into some bonds or go into some cash to really take advantage of investor sentiment and the behavioral biases that are built in to the investor sentiment cycle. Again, what we're trying to do here is remove our portfolio from that outside circle, because it was drifting closer and closer to that investor sentiment, and really move it back to that market cycle where we want to reside, that's data driven. So what is not changing in active risk management? It's still 100% data-driven process. We use Ned Davis Research, who's an outside firm who's been doing this for 35, 40 years, a lot longer than I have. and they have tremendous results and tremendous data. We're still using our internal risk model to judge the markets, when we should be taking more risk, when we should be taking less risk. It means still adjusting portfolio risk, just allowing for more shades of gray in the market. And the big thing to remember is we are not changing our outlook. We are still focused on the long-term risk-reward profile of the market. Again, we don't feel focusing on the short term is the best way to manage portfolios. By looking at short-term performance, looking at those ups and downs in the cycles, you tend to drift towards that investor sentiment cycle, the outside ring, and away from that internal market cycle models, which is where we want to be. So in short, when we're doing these changes, we've removed trend following, and we've changed our hedging process from an all or nothing process to a more shades of gray process called dynamic asset allocation. So what are we trying to accomplish with this? Like I said before, I had two favorite charts, and this is my second favorite chart. And what this represents is another way to look at the investor sentiment and the market cycle. As the markets go up, and again, it could be any market, it could be U.S. equity, could be foreign equity, could be bonds, could be your portfolio. As markets go up, they go down, they go up over time. You've seen this throughout history, wash, rinse, and repeat. Markets go up, markets go down over a full market cycle. And what we really want to do is at the appropriate times, either preserve, protect, or grow your portfolio assets. So as we're seeing the market cycle, as markets bottoming out and rising up, we want to be adding risk. It's prudent to grow your portfolio. We want to be taking risk in your portfolio, adding to equities, adding to those risky assets. When we see it kind of risk increasing in the market, we want to preserve what we have. We'll be adjusting risk down, selling 10%. In the hedging, our old way of doing this, we would have to remove a large amount of risk in your portfolio when the data weakened, not bottomed, when it weakened. And what we want to do is be able to better adjust the portfolio to take advantage of this market. And then as markets go down, we want to protect our assets as much as possible, moving more into less risky assets. Again, the market cycle, which is where we want to be buying, preserving, and then trimming back risky assets. This is what we're attempting to do. And what we've seen in the investor sentiment cycle, where we don't want to be, investors tend to reduce risk, and start adding risk here. And that's what we're trying to prevent. Again, these changes really are evolutionary, not revolutionary. They are the result of many of hours of research, of analyzing, and again, it's something that we constantly look at. It's not something that just happens overnight, and it's not a reaction to what we've seen in the short-term performance. It's more looking at that investor sentiment cycle compared to the market cycle and making sure your portfolio is more closely aligned with that market cycle and away from that investor sentiment cycle that leads to poor investment returns and poor investment decisions. So again, these changes really are an attempt to do that. So how is this going to be reflected in your portfolio? If we look at this next picture right here, we have what we call a dynamic asset allocation for our typical moderate client or in a moderate risk level. We have these set up for all three risk levels, but in the sake of time and space, we're going to use the moderate as an example. If you would like, on the website, www.stonehearthcapital.com, we have the conservative, moderate, and aggressive all out there under our traffic light. And the first thing you notice is you'll see green, yellow, red, just like our traffic light is current in our previous process. And we're still using this. So you'll still be able to go on the website. And what is this telling us? So we're looking at the equity exposure here, which is right now 60% for a typical moderate investor. This is a benchmark. This is static. So a typical moderate, no matter if the market's going up or market's going down, they will have 60% equity, 30% fixed income, 0 cash, and 10% in alternatives. We feel by adjusting these weights, especially the equity, which is the most risky assets, we can better take advantage of the market cycles out there, move away from the investor sentiment and closer to the full market cycle. So we look down below in what we call a green light is when equity in your portfolio, if you're a moderate risk level, would be between 45% and 80%. Again, right the edges of the 60%. So as we see risk increasing in the market, where we're reducing your equity exposure. As long as we're over 45%, you can go on our website and look at this at any given day, and you'll see how much equity exposure we're taking within these ranges. If you see a green light, you know that we feel that we're in a normal or risk environment or the ability to grow your portfolio, and we'll have the appropriate equity weighting. Once risks start increasing and we see markets start to rise and we want to adjust risk, once we fall below 45 but above 20, we're in a yellow light, just like we currently are now. You'll see equity exposure go all the way down to 20%, perhaps, depending on what the data is telling us to do, and you'll see this as a yellow light. When, hopefully we don't see this again, but unfortunately we probably will at some point in our lives, when we get to another 2008, another 2000, we'll be in a red light, and we'll have the least amount of equity exposure we can for a moderate investor, invested 20% in equity. So again, what we're doing here is really letting the process drive, are we in a green light, a yellow light, or red light? And these basically encapsulates all the changes we're making to the portfolios. We feel, again, the best way to achieve positive portfolio outcomes and achieve your goals is to stay away from that investor sentiment cycle and more towards that market cycle where we really want to play. And we feel these changes will allow us to improve the process, which will lead to better portfolio outcomes in the future. So again, I know there's a lot of information and we went through it in a measured manner, and I wanted to really leave a lot of time set aside for question and answers. So like I said before in the housekeeping notes, please read compliance disclosures. And with that, I'm going to take a little minute to kind of gather the questions, and we'll go through in a question and answer period. So the first question is about shades of gray and introducing emotion to investing. I don't believe so. I do believe shades of gray allow us to better defend against emotional investing. So when you think about the decision process and how our data drove it, we could see the market and we could see some of our data weakening. And we really couldn't take advantage of that because we had this all or nothing approach. We really had to wait until we see a full-fledged yellow light in our process, in our hedging process. And it really wasn't leading to positive outcomes. It was bringing too much emotion to the decision. It was all or nothing. Should we sell everything or should we not sell everything? And by changing that to shades of gray, we can better take advantage and defend against emotions, number one. Also, two, it helps us take advantage of what we're seeing in the marketplace, how the market really is working now, given these structural changes due to the rise of ETFs, the rise of computer trading. So we really feel this helps remove emotion, not increase the emotional impact of investing. So in terms of dynamic asset allocation, what data are we looking at? We are looking at the same data we looked at for a hedging process minus the Sherman sheet. We didn't feel the Sherman sheet was adding a lot of value. So we're still looking at Ned Davis, we're still looking at internal risk model, and we tend to view the market through three different lenses. We view it through fundamental valuations, we view it through macroeconomic, and we view it through technical. And what we want to see is that all three of those agreeing what we should do. So when we look at the fundamental, we look at things like price to earnings, book value, the Shiller Cape PE, how expensive is the market? Again, the market can be expensive for long periods of time and still not have a big drawdown. So what we see in any one data point really can't tip the market. It really needs all three of the individual data points to be telling us that. We look at the economic environment because most, and not all, but most large market sell-offs occur during a recession. So we're looking at forward-looking data to help us better understand when the risks to a recession are rising. So when we see jobs not being created, when we see new orders declining, when we see manufacturing decreasing in the US, we see that as an increase in the likelihood of a recession happening. So that's the data we're doing there. In terms of technical, we look at the market. What is the market telling us? Are more people buying than selling? Are cyclicals, which are kind of riskier stocks in the market, rising faster than the old safe havens? That proves that it's probably more likely that we should be growing your assets than playing defense. So those are what we really look at for the grow, preserve, and protect piece. Is we look at market valuations, macroeconomic data, excuse me there, I lost my train of thought, and the technical data to really pinpoint how much risk we should be taking in your portfolio. Is the red light indicating blood on the street? It is indicating blood on the street. In the new structure, the red light is indicating more of a high point in the market. So again, what we're trying to do is stay away from the investor sentiment. In the old structure, you are right, the red light kind of typified the low point of the market. What we want to do is identify the high point of the market with our red light. So as that market peaks, we should be decreasing our equity exposure and hopefully be more in a red light. So we're trying to, again, get away from that investor sentiment and more closer to the full market cycle, that investment market cycle, which we want to play. When I mention equities, I'm mentioning not individual equities, but equities in general. So I'm using it as a catch-all for equity mutual funds, equity ETFs, individual stocks. And we have a question about dividends. We do feel dividends matter. We do get dividends on ETF and the ETF, but it's not the driving force. It's actually a big piece of our market valuation where we look at how much equities are actually paying. Have you back tested your new approach? Well, it's funny. I've never seen a back test out there that I didn't like, because anything that's bad, you just disregard. So we have looked at historical returns based on this new market approach. I'm wary of using back tests to prove anything, since we let our biases creep into that process. I mean, it's the benefit of hindsight, 2020. I know what happened in the market 2 years ago, so I can design a portfolio process that takes advantage of that. Unfortunately, that may not happen next year or the year after, dealing with a different market. So we want a robust process. So yes, we look at historical performance to make sure that it actually has a sound basis. So we want to look at, does it work in the past? And if it has worked in the past, we want to understand why. So we always want to know why it worked. Is there a reason it works? And is it going to work in the future? So that's how we kind of view back tests. We don't view it as the end-all be-all, because you can let your hindsight creep into it. But historically, we feel this has been a better way to manage money. Interesting. So I got a couple questions on market timing. No, this isn't market timing. It gets grouped into there. And I think the big difference between this process and what people consider market timing is the investment horizon. So to me, market timing is, as an example, I come into the office today and I look at the equity market and I say, you know what, investors are pretty nervous. They think they're going to sell the market off. The market may go down by 5% over the next few days. That's my belief. I don't do that. I don't think it's the right way to do it. And then you trade around that. That to me is market timing, taking advantage of these little wiggles and waggles in the market that nobody can predict. What we're trying to do is look at the long term, at factors that historically have been present in markets that have shown to be weakened or strong, and then take advantage of that over long-term investment horizons. So we want to take advantage of those people market timing, trying to get in and out of the market, and when the long-term risk-reward profile is in our favor, we want to be growing assets. And when it's not in our favor, we want to be preserving or protecting assets. Again, market timing to me is that outside investor sentiment wheel, and what we're doing is removing emotion and staying within that full market cycle, that investor market cycle, not the sentiment. Couple questions on Trump and Clinton and Bernie and everything like that. I'm going to leave that for another day. We should talk about that at our upcoming breakfast seminar. I believe it's going to be in May, and we can discuss that a little bit. But I'll address it a little bit because it is interesting. I'm following it closely like everybody else is. And historically, we have seen the president does not have a big impact on the markets over the long term. They may be able to affect the market in short-term wiggles and waggles, but the president really doesn't have a lot of power over the markets, not a lot of influence. So I think the biggest thing we're going to see is a lot of noise and a lot of short-term gyrations in the market when Trump goes out and says he's going to start a trade war with China, or Bernie says he's going to take everybody's money and give it to everybody else. So I think you're going to have a lot of noise around that. That's not what we do. That is more market timing. What we're going to do is let the data dictate and what the data is telling us. Again, looking at it through the fundamental lenses, how cheap or expensive equities are, the macroeconomic environment, is it getting better? Is it staying the same? Is it getting worse? And also the technical picture, what are the individual people who are trading this market telling us? In terms of the new strategy and increase in trading, doing this back test or looking at it historically, we feel the trading probably won't change on a dollar value. What does that mean? So in the old structure, we had trend following, which every 45 days looked at individual asset classes and decided if it should buy or sell based on price momentum. That caused an increase in trading. We used securities that had no trading fees to better account for that, but it caused us to trade a lot. Also, the hedging, if you think about what happens when we remove half your equity, we're trading 20, 30% blocks of your portfolio at one time. And then also, on the other side, you have to buy back into the market. So then another 30%. So what in the new environment, we don't have the trend following, so we're not going to be looking at markets every single 45 days to trade. And also, as we adjust risk in your portfolio in a more gradual manner, you may see more trades in your portfolio, but that dollar value, that 20% of your portfolio, is not going to be traded all at once. You may see it in 5% increments, 10% increments to add up to that 20%. So we don't think the dollar value is going to change. We don't think we should see an increase in fees from trading. We use a lot of products at TD that allow for no transaction costs to help us with that. So we don't really see an increase in dollar value trading. So we've got a couple of questions about where we are right now in the current market environment. Again, we entered into this change in a yellow light. We entered into a yellow light back in January, and basically what we're seeing is we saw an overvalued market, which has been overvalued on the data for a while. We saw some weakening in the economic environment. So some new orders were decreasing. Manufacturing, which is basically a measure of how robust manufacturing is in the U.S., started to decline a little bit. We were still creating jobs, so that was a positive influence. We saw some key technical levels break. We saw a breakthrough as 200-day moving average. We saw the less risky parts of the market start to outperform the risky pieces of the market. So taking all that together, the weight of the evidence approached, it was prudent to take some risk off the table. Now, since the January low, the market actually is up a little bit from there. And then we have to look at the decision-making in terms of the process and not the outcome. Was the process sound? And I think with these changes, we're going to help better adjust portfolio risk in the portfolio. So it is prudent to be a yellow light. I do feel you will see us increasing risk in your portfolio going forward here very slightly. I think you'll be seeing us add to some emerging markets, which is basically the risky part of the foreign investment side. I think you'll be seeing us add to the equity exposure in portfolios. So again, we made these changes to better be in tune and harmony with the market cycle, and I think you'll see that in some trades coming forward. But there's no plans to trade right away. We'll let the data tell us when we should be trading. So as I'm going through the questions here, I think we got to all of them, which is very good. I appreciate the questions. They were very good, and I hope you got a lot out of this. So if there are no more questions, and please type them in as you see fit here, I think we're going to end this. So again, I want to thank everybody for joining us in this. And again, I just really want to reiterate to go back to what we're really trying to accomplish here. And the best thing I could do is go back to this slide we showed in the beginning. I'm sorry for the mechanics of this. And really close with this slide. So what are we trying to do with these changes? Again, we felt the old portfolio structure was causing us to drift to this poor investor sentiment cycle out here where bad decisions lead to bad outcomes. And by making these changes, instituting these changes, removing our internal trend following model, changing from an all or nothing approach to a more shades of gray, we are better able to bring the process back in to this investment market cycle. Again, buying low, selling high. And this is a major improvement to our process, which will lead to major improvements in outcomes. So with that, I am going to, one more question just popped up about performance of their portfolio. Again, on these conference calls, I cannot talk about any individual portfolios, but we do have two ways for you to calculate your portfolio performance. One, when you meet with Rich, Jamie, or David, we have what we call a meeting report, which lists out our performance over multiple time periods. And also every quarter, either via email or the vault on eMoney or mailing, you get a performance report within your quarterly report. So that's where you'll be looking for your portfolio performance. And again, if you have any individual questions on your individual portfolios, please feel free to call the office anytime. Rich, Jamie, David, or myself could always help you and walk you through this. And with that, I do want to say thank you for joining us. I am available anytime to discuss further if you want to go into more detail about your portfolio, about these changes. We'll be touching base on this in our breakfast seminar coming up. And again, I'd like to thank you all. Looks like the snow stopped over here in Danvers, so we should all have a safe commute home from work if we're commuting from work. And thank you, and enjoy the day.